We were going to talk a little, I guess we could talk a little bit, we've got some time here before hours up, about the tax strategies with real estate. First of all, you get depreciation, and I'll just run this by you. A lot of people don't realize this in real estate, but you get a passive paper write-off of depreciation, which means take the value of the building, and that means just take the value of the land off the market value of the property, and then you divide that by 27.5 years, and that's how much your yearly depreciation write-off is. And so if you take a $150,000 building, divided by 27.5 years, that's about a $7,000 paper write-off every year. If you can't use the paper write-off because you make too much money, which means making over $150,000 of just grossed income per year, it carries over to the next year. In other words, depreciation does not go away; it just stores up in the property. And this is a strategy a lot of realtors don't talk about, but you can use that. You can use that to stored up depreciation in your retirement years when your income is not so high to offset the positive cash flow on your free and clear property, and therefore you would have pretty much tax-free or tax-protected income during your retirement years. If that was a mouthful, then give me a call and I'll explain it to you a little bit better. I'm not a tax expert. I'm not a CPA, so I can't give you tax advice, but I can give you the general idea, and then you can run it by your CPA and get their information on it. And you can also become a real estate professional, and you would get unlimited passive write-offs. That's why I haven't paid taxes in a long time, because I own enough rental property that my income is sheltered as a real estate professional. And that doesn't mean a real estate license. It just means a real estate professional, as the IRS would call it. So there's some rules about that. All you have to do is go into Google and dial in real estate professional IRS, and you'll find plenty of information on how to use that to protect your income. This is a great way to protect. This is the doctor scenario where the doctor or the husband or wife is a doctor. The other spouse will stay home and become a real estate professional and do the required activities. That means the rental property they own will shelter their current high income. That's something that Maria, one of the people here on our call, that we talked about when we met, because she's a stay-at-home mom buying up rental properties now, and her husband does very well in the high-tech industry, and very soon that depreciation of the property she owns will now not only offset her positive cash flow, but it will also offset the ordinary income of the spouse. Pretty cool. And of course, 1031 deferred exchanges. This is another strategy of how to buy more property without paying taxes. You actually defer the taxes, and it needs to be done specifically. So if you are going to buy a property here in the Austin, Texas area using a sale of another property, we highly recommend you talk to me first. We'll get you set up with an accommodator and get your CPA to run everything by, because you want to be able to defer your taxes, not pay capital gains when you sell it. And the great thing about, the old rule is you can't avoid death and taxes, but there is actually a way to avoid taxes at your death, and that's what's called a stepped-up basis. So what happens is all the appreciation that goes on over the years on these properties, when you pass on and your kids inherit this property, they get what's called a stepped-up basis, which means that all that appreciation that was stored up in the property, the kids now, their basis in the property will be the value of the property at the time of passing, which means that if you sold it the day before you died, you would have paid 15% plus a lot of extra taxes. But if you pass it on to your kids, they won't pay any of that you basically avoided taxes. All right? A little crash course on tax strategies. Yeah, I get this question a lot, about selling your primary residence. You can live in your property. All you have to do is live there 2 out of the past 5 years to claim the exemption, and that exemption is $250 to $500. What we see is another strategy in the retirement is you buy a retirement home now, keep it as a rental, and then eventually move into it later on down the road. And as long as you live there 2 out of the last 5 years, you would then avoid the capital gains if you sold it. So, if you bought 5 rental properties and in 20 years when they're all paid off, you moved into each one separately and lived there for 2 years, all that appreciation, all that doubling in value would now be tax-free if these exemptions are still in place in those years to come. So pretty interesting strategy that you may have not have thought of. I'm not going to go too much into self-directed IRAs, but I will tell you that people are using their self-directed IRAs to buy investment property, and there's some very strategic ways to do that. And I can certainly discuss that with you, because being able to tap into your self-directed IRA and pay cash puts you in a better buying position than if somebody has to go out and finance. You're competing on an offer against somebody that has to finance.